Hey everyone, welcome back to the Noob Selling Options channel. Today we've got an explainer that, well, it really separates the veterans from the true beginners. We are stepping away from those easy textbook wins today, and we're diving deep into the gritty, unfiltered reality of defending a losing position. Because let's be real, when the market squeezes, when the pressure mounts, and your margin starts flashing red, what do you actually do? How do you survive the squeeze? Well, in this explainer, we're going to walk through a live, battle-tested example of exactly how to handle it.
Okay, let's dive right into our roadmap for today. First, we'll look at the SNDK defensive role. 2, the psychology of survival. 3, ergodicity and risk of ruin. And finally, 4, the long-term thesis.
All right, part 1, the SNDK defensive role, trench warfare.
Look, repairing a tested strangle is rarely pretty. It is muddy trench warfare. You are quite literally in the trenches, defending your capital against a relentless market. And taking this kind of damage, it stings. There's absolutely no sugarcoating it. But when you're managing high volatility tech names like SNDK, especially in an AI-focused portfolio, rapid price movement just skyrockets your margin requirements. If you just sit there and hope it gets better, you're risking your entire portfolio. So taking a localized hit right now to relieve that margin pressure, that is how you stay alive. Now, what's really interesting about this repair is the actual math behind it. Let's break it down, starting with the call roll. We bought back the June 2027 1910 call and sold the February 2027 2020 call. Now, that results in a hefty net debit of around 11.7K. But look at what that debit actually buys us. It pulls our timeline significantly closer, and crucially, it pushes our strike price up by a full 110 points. We are buying ourselves breathing room. Then, to kind of soften the blow, we look at the put side. We navigated the puts by buying the 600 and selling the 700 strike, which actually brings in a credit, and that credit directly offsets some of the massive costs of that call repair. Because you've already harvested good premium from this position in the past, you're essentially just giving some of that premium back to the market to free up your margin.
Moving on to part 2, the psychology of survival, instincts over math.
Amputate the limb to save the life. To understand why we would willingly take an $11,000 hit, we really have to peel back the onion here. In evolutionary psychology, the human brain is hardwired to prioritize existential threats over potential gains, right? I mean, finding a bush full of berries means absolutely nothing if there's a predator waiting inside it. Well, in trading, your margin is your lifeblood. When a position moves violently against you and threatens that margin, your brain's amygdala literally flags it as a lethal threat. The primal instinct here is to amputate the limb to save the life. By executing that expensive role, you are willingly accepting a localized injury, a realized loss and a hefty debit, because the alternative is a cascading margin call or a full account liquidation. And that's fatal.
Which brings us to a foundational concept in behavioral finance, loss aversion. It's a key part of prospect theory. Basically, humans naturally feel the pain of a loss twice as intensely as the joy of an equivalent gain. And this psychological phenomenon is exactly what destroys novice traders. It causes them to freeze. They completely refuse to close or adjust a losing position because doing so makes the loss real. So they just sit there, totally paralyzed, hoping the market will miraculously bounce back.
But the survival psychology we're applying actively overrides this loss aversion. You have to recognize that the sheer magnitude of the existential threat to your account heavily outweighs the temporary sting of realizing a loss. You've got to force a massive mental shift. You are shifting from the novice mindset of I don't want to lose money to the professional mindset of I absolutely refuse to be taken out of the game. You are taking control of the narrative rather than letting your broker or the market dictate your fate.
All right, part 3, ergodicity and risk of ruin.
Okay, we've covered the psychology, but we also need to mathematically validate why survival always trumps profit. And this brilliantly illustrates the concept of ergodicity. In probability, a scenario is ergodic if the long-term average outcome is the exact same as the expected value of a single event. But here is the crucial point for us. Trading is profoundly non-ergodic. Why? Because of the risk of ruin. Let's say you have a brilliant strategy with a 90% win rate. Sounds amazing, right? But if that 10% loss completely wipes out your entire account, your long-term return is inevitably, mathematically, zero. You simply cannot compound capital if your capital is gone. Expected value and profit margins are entirely secondary to staying solvent. Being right eventually just doesn't matter if you get squeezed out of your position before the market even turns.
So, managing a volatile portfolio ultimately comes down to contrasting two totally opposing mindsets. On one side, you have profit maximization, just sitting on your hands and hoping for a bounce. On the other, regret minimization, acting defensively to avoid catastrophic liquidation. Taking a $10,000 plus hit? Yeah, it stings, but it is a manageable, quantifiable pain. Now imagine the psychological regret of doing nothing, getting a margin call, and being forced by your broker to liquidate your core holdings at the exact bottom of the market. That would be completely devastating. Taking damage to buy time isn't defeat. It's just the tactical cost of operating in deep, volatile waters.
Finally, Part 4, the long-term thesis, or the road to recovery. Because guys, this is where the magic happens. The core thesis of this strangle repair actually remains fully intact. Despite the massive debit we paid to adjust the call side and defend our margin, we have a really deep buffer. Because we consistently collected cumulative premium across previous cycles of this trade, if both sides of our newly adjusted strangle decayed and expire worthless, the net P&L for the entire lifespan of this trade will still be approximately positive $3,000. Think about that for a second. You took an $11K hit just to survive, and you can still walk away with a profit.
However, we've got to be realistic here, realizing that max profit requires acknowledging the active threats and helpers on the board. Working in our favor, good old time decay, or theta. We've pushed our expirations out, so time is slowly eating away at the option's value, which obviously helps us as the seller. But the active threats are definitely still there. Volatility, or vega, can expand and hurt us, and the sequence of returns can challenge our strikes all over again. The absolute requirement going forward is continuous, active management. I fully anticipate this position is going to require multiple future rolls to defend strikes and manage buying power. It is an ongoing battle for sure.
And honestly, that is exactly what it takes to master the trench warfare of options trading. Showcasing these battle-tested, completely transparent repairs, that's what builds real trust. It's super easy to just show the winners online, but surviving the losers is where the real education happens. If you found this breakdown of the SNDK defensive strangle helpful, please make sure to like this explainer and subscribe to the Noob Selling Options channel. We love making these for you. But before you go, ask yourself this. The next time your portfolio flashes red and your margin shrinks, will you freeze and hope for a bounce, or will you amputate the limb to stay in the game? Stay disciplined, protect your margin, and I'll see you in the next explainer.